Hi everyone, this is the online lecture for monetary policy. Um, in many ways, this is a continuation of what we have talked about last week in money and banking, how commercial banks create money. So in this chapter today, we will be looking at how the central bank control this process to control the amount of money stock in the economy. Now, why do they need to control the amount of money stock in the economy? What has money got to do with our economy outcomes, like your price, like your unemployment, like your real GDP? We'll take a look at that now. Now, last week we learned about the four functions of money. This week we learned about why people want to hold on to money. Okay, what is the demand for money? Now, the demand for money refers to the amount of money that people plan to hold as cash or deposits in the bank at any given time, largely referring to M1. Okay, why do people demand for money in the form of M1? We learned last week was M1, the currency in active circulation, and um, our demand deposits. Okay, so this refers to the amount that people want to hold as part of cash, as part of their demand deposits or their current accounts. Now, I mentioned in lecture that money demand is not a wish list. You cannot demand that you want $1 billion. You can't. Okay, money demand means that out of how much you have now. Now, regularly people hold different forms of assets like houses, like stocks, like bonds, other financial kind of investment, insurance, as well as cash. Now, money demand refers to how much out of your own wealth do you want to hold as cash or demand deposits? Okay, do you want to hold as money? So how much you want to hold as money cannot exceed the wealth that you have. Okay, you cannot demand for money that falls down from the sky. You can't. Okay, so it must be based on how much you already have. All right. Now, for example, out of $1 million wealth, how much would you want to hold as money, or how much would you want to invest with banks? This is what we mean. So the amount of money that people want to hold, all right, as money out of the $1 million wealth that can consist of many things, like what we mentioned earlier, this would be their money demand. Okay, how much they want to hold as money as part of their overall wealth. Now, we talk about why then do people want to hold on to money? What is it about money that they need to hold on for? So we have three motives for holding on to money. Why people want to have money with them instead of other assets like houses, stocks, or bonds. The first is transactions motive. Transactions mean people need money to pay for their day-to-day things. Okay, you go Cheers, buy something, you need to pay. You go canteen, buy something, you need to pay. All right, you go to Booklink, you buy something, you need to pay. So when you need to pay something, you need cash. So people want to hold on to some cash to handle or to pay for their transactions. Okay, when they need to buy things. Now, people also need to hold on to money as a precaution. Okay, now precaution for what? When they fall sick, you need money to pay for doctor. Okay, and in case something happens, you have a sum of money to fall back on. So this is what we mean by precautionary motive. You keep money as a form of precaution. Okay, some people when they travel, they also bring along more money with them just as a precaution. Okay, so this is precautionary motive. Now, just now we mentioned that people can choose to hold part or all of their wealth as money to buy goods and services. But the problem is money does not generate any interest on its own. Now, this is very different from holding your wealth as other things other than money. Now, you can hold on to your wealth as bonds, for example, or deposit your money in the bank where you open up an account with a bank. I showed you guys in the lecture that banks like DBS offer you an interest when you deposit money with them most of the time. Okay, so bonds, deposits, investments all generate returns and interest. Okay, so why would people want to hold on to money or hold on to other assets? When and why do they do that? Okay, now money, you just now we mentioned, you have a precautionary and transactionary motive. Okay, you still need money for a day-to-day basis, but people also want to hold on to other assets to earn some interest. So how much money or how much assets to hold depends on how much is the ongoing interest rate. Okay, in the next few slides, we're going to look at how interest rate is formed in the economy. Now, this is the money demand curve. Okay, it's a downward sloping curve like your AD. Okay, now downward demand curve means when money is expensive. That means money carries a high interest rate. Okay, the amount that people want of money is very low because people rather put their wealth into bonds and other deposits, other assets. Okay, so that they can earn a higher interest rate. But when the interest rate is very low, people would rather just hold on to money because you put your money into other assets, it doesn't fetch much anyway. Okay, so the demand for money is downward sloping. When the interest rate is high, people don't want money. The quantity is very low. People prefer to put it in other assets. When the interest rate is low, okay, people rather just keep money because not worthwhile to go to the bank and then open up a new account because interest rate is so low, not worth a while. Okay, so that's why money demand is a downward sloping curve. Okay. Now the money supply curve on the other hand is a vertical line, okay, a vertical straight line. Now this is because the amount of money stock in the economy at any point of time is decided by the central bank and only the central bank decides. So because they hold absolute power of the amount of money stock in the bank, this money supply curve is a vertical line. That means there's no other influences that can influence the amount of money stock other than the central bank. Okay, they have absolute control over how much money is circulating in the economy. Okay. Now together, the money demand and the money supply will give you an equilibrium interest rate. Alright, so money demand and money supply meet each other at the equilibrium. This will be the equilibrium interest rate. Now, I mentioned in the lecture that in the economy, especially in finance, there's so many different rates. Different rates for lending, different rates for deposits, and within deposits, different interest rate for different deposit accounts. How come on the diagram there's only one rate? Now, this is the one and only central rate that's determined by the central bank. Okay, in the real functioning of the economy, there are many interest rates, higher or lower. Okay, but it all follows the change in this interest rate. So when interest rate, this main interest rate that's set by the central bank go up, all the rates go up in tandem. When this rate goes down, okay, that means central bank reduce the interest rate, all the rates will fall in tandem. Okay, so this to simplify matters that there's one interest rate only. But in the real world, there's a lot of derivations from this interest rate depending on the product. For example, deposit rates are usually lower, so probably it'll be below these equilibrium interest rates. Loan rates probably higher and it'll be above this. Okay, so in the real world, there's a lot of interest rates, but they surround this central interest rate that's set by the central bank. Okay. Now your money demand curve can shift to the right. That means for the same interest rate, people want to hold on to more money. Okay, now when would you need more money when the interest rate does not change? Now when your income goes up or when the price level goes up. Okay, now just imagine when you earn more money, usually you would want to keep a higher amount of money with you. Okay, or when things become expensive, when price level goes up, you want to keep more money with you, maybe to buy the same amount of things, you need more money to pay for them. Okay, so your demand for money will go up when your income goes up. You're richer, probably you want to carry more money with you, or when things become more expensive, you want to keep more money with you to handle your transactionary or precautionary needs. Okay. Now, money supply can shift to the right or shift to the left, depending on what the government wants to do. Okay, this is what when we go into what is monetary policy. Okay, why is it that the government wants to increase money supply? Why is it that the government wants to reduce money supply? What impact does it make to the rest of the economy? This is what monetary policy is all about. Now, in this case, when money supply increases, okay, money supply curve shifts from MS to MS1. Okay, now as a result, the equilibrium point also changes from here. Okay, where the interest rate is R1, you go down to R2. Okay, now when we study monetary policy, we want to know how does the government increase the money supply. Okay, how does it increase the money supply so that interest rate falls? All right, let's take a look. Now, central bank does not pump money into the economy directly. Okay, like we learned last week, what happened is money is created by this group of commercial banks when they lend out money. Okay, what central bank does is to control the amount of lending by this commercial bank so that it can control the amount of money stock in the economy and therefore the interest rates. Okay, so it doesn't control the amount that's going into the economy directly, or neither does it pump money into the economy directly. Okay, contrary to popular belief, what central bank does is to control the amount of money creation in the economy. Now, the central bank controls commercial bank lending and therefore money creation, thereby controlling the amount of money that's flowing into the economy to the consumers and businesses. Okay, now how does the central bank control these commercial banks and their money creation? Using three technical tools and one more, we will talk about that later. Okay, but three technical tools: the required reserve ratio, discount rate, and securities. Okay, we're going to look at how do all these tools work to control money creation by these commercial banks so that central bank can control the amount of money stock, all right, and therefore the interest rate. The first of these two is the reserve requirement ratio that we learned last week. Okay, that means the central bank will rule that the commercial banks need to hold a certain percentage of their total deposits and cannot lend out. They have to cap in the bank as required reserves. Okay, so it cannot be loaned out. So the more the commercial banks have to keep with them, the least they can lend out. Okay, the lesser that they keep, the more they can lend out. Okay, so central bank control how much they must hold, uh, uh, which is part of the deposits, and they cannot lend out. All right, to control how much they can actually lend out at the end of the day. Okay, now supposedly that the central bank set the triple R as 20%. So commercial banks must keep 20 million with them in the bank at all times, and they can only lend out 80. Now this rate can change. Central bank can change this rate, and it applies to all banks, not just one bank. Okay? All the banks must follow. So in this case, when the triple R is raised to 30%, the commercial banks have less amount to lend out. Okay, previously when it was 20%, commercial banks have excess reserves of 80 million that they can lend out. Okay, now it falls to 70 when the triple R goes up. On the contrary, when the central bank decreases the triple R, let's say to 10%, the amount of excess reserve that the commercial banks have will now increase to 90 million, which they can lend out. Okay, so the triple R directly control how much amount that the banks can lend out. Okay, which effectively controls money supply. Therefore, when we summarize how triple R works, the required reserve ratio works, if the central bank wants to increase money supply, it will lower the triple R, okay, lower the reserve requirement. So as a result, commercial banks need to hold less reserve, which means that they can lend out more money. So money supply will rise, okay, via the money multiplier, which we learned last week. Okay, if the central bank wants to decrease money supply, it will raise the triple R. Okay, raise the triple R. So commercial banks now hold more reserves and lend out less. Okay, because they have to keep more required reserve with them. So as a result, money creation falls and money supply will fall. The next two is open market operations, whereby the central bank buy or sell government securities in the market in order to influence money supply. Now, what is government securities? Government securities is just a token or an asset that the central bank can force commercial banks to buy or to sell to, okay, to control how much excess reserve that they have. It's like a token of exchange. Okay, the idea is to control the amount of excess reserves that the commercial banks hold. If the central bank, for example, wants to increase money supply, it will buy government securities in the market, okay, from the commercial banks. Okay, now when you buy things, of course, you're going to pay. So central bank will pay to the commercial banks, and therefore commercial banks will now have more reserves. Okay, and as a result, with more reserve, they can afford to lend out more. And when they lend out more, money supply increases. Okay, now if the central bank wants to decrease money supply, it will try to reduce the amount of excess reserve that the commercial bank has. So what it does is it will sell government securities to the commercial bank. Okay, sell to them. Of course, when you sell to them, you collect payment, right? So commercial banks, after paying, they will have less reserves, and therefore they have less ability to lend out. And as a result, money supply will fall. Now, this buy and sell is the crux of this whole market, open market operations. If there's a question on this, you must be able to tell when does the central bank buy government securities, when does the central bank sell securities. The perspective must be on the central bank, not the commercial bank. Okay, so you are the government that is trying to resolve certain problems, so you take on the position of a central bank. What do? Buy securities or sell securities? That will depend on whether you want to increase money supply or decrease money supply. Okay, the next tool is discount rate. Now, discount rate often causes a lot of misunderstanding among students. They think it's some kind of sale discount. It is not. Discount rate, the word discount is an old form of describing interest rate. Okay, and in this case, it is the interest rate. Okay, now this interest rate is not open to the public. It's the rate at which the central bank will lend money to the commercial banks. Okay, now the central bank facilitate all kinds of money activities. So when necessary, it will also lend out money to the commercial banks. And of course, you don't lend out for free because it's the people's money. You charge an interest. Okay, by controlling how much this interest is, the central bank can encourage or discourage the commercial banks to borrow from it. Now, of course, when the commercial banks borrow more from the central bank, they have more excess reserve, they can lend out more. When the commercial banks borrow less, they have less excess reserve, they lend out less. When the central bank wants to increase money supply, okay, it will lower the discount rate. That means the interest rate that it charges the commercial banks from borrowing from it. Okay, now hoping that you will encourage them to borrow more money from the central bank. Okay, and when the commercial bank does, okay, they have more excess reserve, they will lend out more to the public. Okay, therefore money supply goes up. Now, when the central bank wants to decrease money supply, it will try to discourage the commercial banks from borrowing money from it. So it will increase the discount rate, okay, charge them more. So commercial banks will tend to borrow less and then lend out less, because since they borrow less, they have less excess reserve, so they lend out less, and money supply will fall. Okay, so by controlling the discount rate, which is the interest rate that the central bank charges the commercial banks, you can actually control the amount of money that's reaching the economy. Okay, because when the commercial banks borrow more, they will have more excess reserve to lend out. Borrow less, less excess reserve to lend out. Now, the last tool is a non-technical tool in which the central bank tries to persuade the commercial banks to follow its guidelines and direction. Okay, the word suasion comes from persuasion. Okay, so the central bank will try to persuade commercial banks maybe to lend out more or lend out less according to what is the ongoing monetary policy. Okay, so this is a non-technical tool. All right, it works by persuasion. Let's take a look at how monetary policy works. Now you can contrast this with fiscal policy. You realize that this is a much longer process. Okay, what we have learned so far is how to control money supply by central bank by controlling commercial bank lending. Now, recalling the diagrams earlier that we learned, money demand and money supply, the equilibrium is the interest rate. Okay, so by controlling money supply, you control interest rate. Now, the next part is the heart of the monetary policy. Now, economists believe that interest rate will affect the level of investment in the economy. Now, why? Because there's an assumption that most businesses, when they make investment, they do so by borrowing money. Now, when they borrow money, of course, they got to pay interest rate. So interest rate directly will affect how much they want or can borrow. Okay? Now, when the interest rate is low, they can borrow more, they'll make more investments. When the interest rate is high, they can't afford to borrow so much, they will make less investments. Okay? Now, you know that investment is part of AD, your CIGXM. When you can control AD, you control real GDP and price level. Okay, the process is quite lengthy. Now, the way that we describe monetary policy is the same that we describe fiscal policy, expansionary or contractionary. Okay, expansionary monetary policy for recession because we want to expand output to overcome the recession, or contractionary monetary policy to curb inflation. Okay, when the prices are too high. Okay, so two different types of monetary policy for our two regular problems. Now let's take a look at expansionary monetary policy. Like what I mentioned, is supposed to help you resolve recession and the unemployment problem that comes along with it. Now this is the below full employment output position of the ADAS. Okay, now this equilibrium is less than your full employment output, so we are having a recession. Okay, you can see that we are producing less than full employment output. Okay, so we are below full employment output, and the difference is our recessionary gap. Okay, which means that this economy is currently at in a recession. So we need to resolve this problem. Now this is how it works. Monetary policy has a total of 3 diagrams. Okay, the first two must be drawn side by side. Now you see the first one, which is your money demand, money supply curve. Now in this case, money supply increases, okay, and therefore interest rate becomes lower. All right. Now remember how you increase money supply. You can reduce your triple R, your required reserve ratio, or you can reduce discount rate, or you can buy securities in open market operations. Okay, so money supply will increase, and as a result, the interest rate, which is the equilibrium of money demand and money supply, will start to fall. Okay, now just now we mentioned earlier that the investment level, okay, is dependent on the ongoing interest rate, because we assume that businesses borrow money to invest. So when interest rate falls, okay, it becomes cheaper to borrow money, investment level will increase. All right. Now, when investment level increase, you can guess the next outcome. In the ADS, AD will rise because investment is part of AD. Okay, so AD shift to the right from AD to AD prompt. Okay, and as a result, your price goes up, your real GDP goes up, you recover the recessionary gap. Okay, and at the same time, your unemployment will fall because your output is rising. All right, so this is how expansionary monetary policy can resolve a recessionary problem. Let's take a look at contractionary monetary policy, how it can close an inflationary gap. Now, this is emphasizing the problem from ADS. Now, our starting point is above full employment output. Okay, it's above. So the current output level is Y and P. All right, at price level P. So we are now producing above full employment output. So there's an inflationary gap. Okay, let's see how we can resolve this. Now, central bank will lower money supply from MS to MS1 Now recall how we can do it with what we have learned earlier. Okay, the central bank can increase triple R, increase the discount rate, or sell securities in open market operations. Okay, now when that happens, money supply shift to the left, and you can see that the equilibrium interest rate is now higher. So higher interest rate. Okay, now when interest rate is higher, we mentioned earlier, we assume that businesses make investment by borrowing money. When interest rate is higher, they're not so willing to borrow as much because it's expensive for them. So what they do is they borrow less, and as a result, the level of investment will start to fall. Okay, so the investment level will drop. Okay, now these two diagrams must be drawn side by side because the interest rate here, okay, is caused by changes in this diagram. Okay, so we always draw them, this money demand, money supply diagram on the left and the investment diagram on the right. It must be like that. Okay, to show that the change in interest rate here is a result of changes in the money demand, money supply diagram. So investment decreases because of higher interest rate. As a result, your AD will shift to the left from AD to AD prompt. So price will fall and then your real GDP will fall. Okay, so therefore inflationary gap no more. Okay, after AD has fallen. All right, so your unemployment rate will also go up because you are now producing less. Okay, but you cause price to be reduced, which was a problem in the first place. So the inflation problem is overcome. Now this is the conclusion of monetary policy. I show you guys in lecture, so please remember, because the process, as you can see, is very long. Okay. Now if you want to counter recession, you deploy an expansionary monetary policy. How? You use triple R by lowering triple R. Open market, you buy securities and you lower discount rate. Okay. Now when you do that, money supply will go up, interest rate will fall. And as a result, businesses take the opportunity to make more investments. So I rises and AD rises. As a result, your price and real GDP go up and your unemployment falls. Now, to counter inflation, you use a contractionary monetary policy. How? You increase the triple R. Okay. You sell securities in open market operations and you increase discount rate. As a result, if you're successful, money supply will fall, interest rate goes up, and as a result, businesses make less investment and AD will fall. Okay, AD falls, your price and real GDP fall, and unemployment go up. Okay, now the process is very long. You should be able to tell how it works. For example, if I ask you, what happens to real GDP when central bank increase triple R? You must be able to map out the whole transmission mechanism. Okay, monetary policy is an important topic, and there are 3 diagrams explaining the entire transmission mechanism. Make sure you know all of them, and please try the monetary policy tutorial questions. Any doubts, please ask your tutors in tutorial. Okay, see you guys soon.